Good evening, everyone. Speaker of the day, Mr. Hiro, Vice President Narayan, Jankana Thakkar, past President of the BCAS, seniors, ladies and gentlemen. On behalf of the Bombay Chartered Accountants Society, I welcome you all to this lecture meeting on Penalties under Income Tax Act Recent Developments. The Society has been arranging at least one lecture meeting of the learned speaker, Mr. Rai, for years now, and we are grateful that he has kept his date for this lecture. This year, we decided a topic on penalties, which is gaining greater relevance in tax litigation and also considering the major amendments in the statute. This provides us also an opportunity to listen to the viewpoints of the learned speaker who has shared his vast repertoire of knowledge on important tax decisions during earlier lecture meetings. The general parlance of the term penalty means a punishment imposed for breaking a law, rule, or contract. In legal parlance, it means a punitive measure that the law imposes for the performance of an act that is proscribed or for the failure to perform a required act. Penalty provisions have always been a part of the Income Tax Act. Section 271 corresponds to the provisions contained in Section 28 of the 1922 Act. Since 1961, we have all been witness to upteam number of amendments to the Section 271, with so many explanations being inserted and also insertion of new penalty provisions. Then we have the various court rulings. Friends, you will be surprised that a simple search on the CCS text online on the keyword penalty throws out a stunning 14,235 case laws and 589 circulars. It is said that penalty provisions are better understood and interpreted in the courts rather than the language and intent of the legislation. Since case laws have significant position in the tax jurisprudence, we have to remain in sync with these developments. However, I wish to take this opportunity to say that it is discomforting that even after 56 years, when the cause for litigation and subsequent determination is bad legal drafting, we haven't really grown up. Tax terrorism has been a potent issue in India for many years. It even made its way into the 2014 election manifesto of the BJP. The Prime Minister, Mr. Narendra Modi, has done well to realize the tax officials that they should remove the fear of harassment most Indian taxpayers live with. This is useful, but the true answer to the problem lies elsewhere. High tax rates, too many exemptions, and a deeply ingrained culture of suspicion has victimized honest taxpayers even while millions sit outside the tax net. Years ago, Nani Palkhiwala, the noted jurist, said, and I quote, "It is no doubt fair and in the national interest to check tax evasion with a firm hand, but it is neither fair nor in the national interest that the law should be made to bear hard on a large number of honest taxpayers merely in order to get a few dishonest ones. To adapt a historical phrase, it is not right that so much should be inflicted on so many in order to rope in so few," unquote. Decades later, these words still ring true. The tax laws could often fit the above description as a result of ingenious drafting, mostly in haste, written in a complex English language. We have yet to learn to make laws that are human and subject to comprehension by normal people. The Ishwar Committee report made several recommendations for easing the burden on the taxpayer and moving away from the arbitrary imposition of penalty. It is disturbing that most of the recommendations have not found flavor or have been accepted, but with a twist. The Finance Minister, with a desire to substantially reduce the discretionary powers of the tax officers, modified the entire scheme of penalty by providing different categories of misdemeanor with graded penalty. The good old Section 271(c) of the Act stands now withdrawn, and penalty will be levied under the newly inserted Sections 270A with effect from assessment years 17-18 and onwards. I am sure the learned speaker will enlighten us with the newly inserted Section 270A, which has classified the penalty into two types, one being case of underreporting of income and second being case of misreporting of income. Also, further amendments to Section 271 AB and insertion of Section 271 AC with Chapter 12A relating to taxation and investment for the PMGKY will all have an element of levy of penalty. We have with us Mr. Hiro Rai. He is an eminent tax lawyer. He is a commerce graduate, chartered accountant, and also an LLB. He has been in independent practice since 1984, before which he worked under two tax luminaries, Mr. Dinesh Vyas, senior advocate, and Mr. V.S. Patil, advocate. He has appeared in numerous cases, having far-reaching impact, and is a regular speaker at seminars, conferences, and events like this. An old and close friend of BCAS, we are glad that he readily agreed to speak today. On behalf of all of us, I request VP Narayan to present a memento to Mr. Rai as a mark of our appreciation and regard. Friends, please join me again in welcoming Mr. Rai.
President, Mr. Chetan Shah, Vice President, Mr. Pasari, Ms. Thakkar, seniors and friends. At the outset, my thanks to the Society for having invited me over this evening. In today's talk, I propose to deal with just one issue of 271(1)(c), and I will be devoting major part of the time to 270A and 270AA. These are new sections basically, so my effort would be to take you through these sections because we are all in the process of trying to understand these new sections, and that is the reason why these sections on my request have been circulated to each one of you. So possibly that is the reason we could appreciate the finer aspects as we go along. I said just that one issue of 271(1)(c), which is gaining ground these days. And to my mind, whenever one is arguing a 271(1)(c) matter, this should be taken up as the very first argument. Of course, facts and circumstances permitting you to take up the argument. 271(1)(c) has two limbs: concealment of particulars of income and furnishing inaccurate particulars of income. The law has developed to say that penalty provisions are to be very strictly construed. Therefore, if the show cause notice regarding the penalty to you is in just the printed form where the AO has not ticked the relevant provision or has not marked what he wants you to respond to, if he has failed to do so, then an inference is drawn that there is a failure on the part of the assessing officer to apply his mind. It also results in a situation whereby the assessee is possibly deprived of what he is to give an answer to. And therefore, the courts have now begun taking the view that if this is the position, then the penalty proceedings themselves are bad law. I believe the first decision was of the Karnataka High Court, which was in 359 ITR, page 565. Manjunatha Cotton and Ginning Factory. This has been followed in another Karnataka High Court decision, 73taxman.com 241. This is SSA Emerald Meadows. This has really speaking followed Manjunatha, the first decision. But I'm making a special reference to this decision because this matter went up to the Supreme Court. And the Supreme Court there has dismissed the SLP. Of course, we are all aware of the position that mere dismissal of an SLP does not mean that the Supreme Court has given the stamp of approval to the decision of the High Court concerned. This is a very well settled proposition. But in the order dismissing this SLP, there was a slight difference. The Supreme Court wrote one line extra, saying that we do not find any merit in this petition. The SLP is accordingly dismissed. This is the order of the Supreme Court on this SLP. Though it's digressing a bit, but I thought I can clarify certain issues. The position in law is this, that when the Supreme Court passes such orders, it dismisses the special leave petition. It does not dismiss the appeal. Therefore, unless there is a speaking order giving reasons for the decision by the Supreme Court, it cannot be held that the Supreme Court has given its stamp of approval to the High Court decision. It only means that the Supreme Court has refused to exercise its appellate jurisdiction because it felt possibly this does not deserve acceptance even at the admission stage. For those who are interested, a nice reading can be obtained from a decision of the Supreme Court in 245 ITR, page 360, which lays down these propositions. 245 ITR 360, Kunam Ahmed's decision. So we therefore have the two Karnataka High Court decisions. We have a plethora of tribunal decisions, including the Mumbai benches. They're taking consistent view, barring one or two aberrations. But consistently the view is being taken following the Karnataka High Court decision that if there is no specification of either of the limbs, then the penalty proceedings are bad enough. In the last part of ITR that has just come out, there is a decision reported of the Bombay High Court also on this. 392 ITR, page 4. This has also followed the Karnataka decision, but it has said that if the penalty is initiated on one limb and if it is levied on another limb, the penalty proceedings are bad in law. This is the essence of the Bombay High Court decision. Of course, various permutations, combinations will arise when you actually sit down to develop this argument when you are appearing in a particular matter. But this is precisely what the Bombay High Court has said in this particular case, though what the Karnataka High Court said was much, much broader. The High Court, Bombay High Court has also noted that when the notice does not strike off the irrelevant portions, that also is indicative of non-application of mind. But these possibly were not the facts in this case, but the fact of the matter is, the Bombay High Court has even observed this. There's a specific line on this aspect also. So possibly we can even rely upon this decision sitting here in Bombay to support this proposition that the relevant portion in the show cause notice should be ticked off. That's all I wanted to bring out on 270 and 1C, because really speaking, everybody is now getting concerned with 270A and 270AA. Though counsel like me, possibly for the next 15-20 years, we are still going to argue 270 and 1C matters. But yes, it is something that affects us because the returns for AY 1718 are going to be filed hereafter. personally speaking, my view has been that the law relating to concealment penalty has developed substantially, and barring a few hiccups that we had in the middle, Dharmendra processors, etc., now by and large the law is getting settled as to in which cases penalty for concealment would apply and in which cases it would not apply. And really speaking, it has developed in the very correct and the right direction. It's unfortunate that this settled position is now being sought to be unsettled. Possibly their effort is to enlarge the scope of penalty. That is why they felt the necessity to bring in new provisions. If we see the memorandum explaining the bill when 270A was introduced, and even this circular which came out recently explaining the Finance Act 16, which has inserted 270A, it says that in order to rationalize the provisions relating to penalty and to bring objectivity, clarity and certainty, the penalty provisions are being amended. Let's see to what extent these objectives are being met. Whether there is going to be any clarity, whether there is going to be any certainty, whether there is going to be objectivity, to my mind, very, very doubtful. And that will become clear as we go ahead to understand these provisions. Subsection 1 of 270A, of course, as you know, 270A speaks of penalty for underreporting and misreporting of income. If we see subsection 1, I'm sorry to all those people who are having to stand, but if you take a look at subsection 1, it lays down the authorities who may impose this penalty. It is the assessing officer, the CIT appeals, the principal CIT or the CIT who can levy this penalty. If you see carefully, it says these authorities may direct that an assessee shall be liable to pay the penalty. These words may bring out the aspect that it is not mandatory, coupled with the fact that there is an opportunity of being heard because the provisions of section 274 are made applicable, coupled with the fact that there are certain exceptions provided in subsection 6 of 270A. All these obviously lead to the proposition that it is not mandatory. Now, these authorities may levy the penalty in respect of a person who has underreported his income. So, precondition is that person should have underreported his income. We'll come to the connotation of this as we go ahead. Subsection 2 lays down the situations where a person shall be considered to have underreported his income. It's worth noting the word used is carefully, he shall be considered to have underreported his income. Not that he is deemed to have underreported his income. Rightly so, because of the exceptions provided in subsection 6. Now let us see in which are the circumstances in which he is said to have underreported his income. There are 6 conditions or 7 laid down in subsection 2. A says income assessed greater than 143(1)(a) determined income. Here we can note that in every case where an assessment order is to be passed, 143(1)(d) requires that there must be a determination under section 143(1)(a). So it's not that this will not work in all cases, it will work. Second situation, where no return of income is filed, of course, the income determined less the basic exemption limit. If there is a difference between these two, then he is considered to have underreported his income. 3, where there has been a reassessment and there is a difference between the reassessed and the earlier assessment or reassessment, in such cases, he shall be considered to have underreported his income. Relatively clear, no problem. These are the situations which are dealing with non-MAT cases, not cases referred to in 115JB, 115JC, etc. These are the normal provisions of the Act. These 3 first, A, B, C, deal with the normal provisions of the Act. Then D refers to MAT income. E and F also refers to MAT income. D says, amount of deemed total income assessed or reassessed. Amount of deemed total income assessed or reassessed if that exceeds 143(1)(a) determination of deemed total income under 115JB or 115JC. Then where there is no return filed, the income determined under 115JB or JC, it follows a similar pattern as in the earlier first 3 clauses. So F says when there is a reassessment where there is deemed total income under 115JB or JC which has been ascertained, then the difference, if there is a difference between this income and the earlier assessed or reassessed income, determining the deemed total income. Seems reasonably okay, clear, doesn't seem to pose very much of a problem. But there's one issue. If you see D, it says the amount of deemed total income assessed or reassessed. Note these words. D deals with or reassessed. So in such case, the difference between that reassessed income and the 143(1)(a) determination. And if you see F, it again refers to amount of deemed total income reassessed, and in F, it is the difference between the first assessment and the reassessment. So there seems to be some problem here. Therefore, let's take an example. If 143(1)(a) deemed total income under 115JB is 100, 143(3) is 150, and 147 is 180. At the stage of the 147, are you going to take the difference between 180 and 150, or are you going to take the difference between 180 and 100? Because possibly this situation is getting covered in both. This, I think, is an anomaly which should be rectified. And I can possibly give you the reason, the genesis why this has happened. At the bill stage, F as it stands now was not there. At the finance bill stage, F was not there. At the act stage, F was inserted, and what was F became G. But when they inserted F, they forgot to amend D, which also includes reassessment. So this is one problem in this particular section. Then there is G. It's interesting. See, please appreciate, one is not nitpicking. These are penalty provisions which have to be very, very strictly construed. Now let's see what the last clause says, G. the income assessed or reassessed has the effect of reducing the loss or converting such loss into income. Intention seems to be to cover loss to loss cases and loss to income cases. Surely so. That is quite clearly coming out. But you see the words. It says income assessed. The same clause is referring to income and loss, but it starts by saying income assessed. Therefore, is it that these provisions do not, as they stand today, cover a case of loss to loss? Loss to income, yes, because there is income assessed. But whether loss to loss, strictly speaking, because of the words income assessed in clause G, there becomes a question mark. Loss to loss. I'll come to certain other provisions which are making a reference to possibly cover loss to loss case, but I will come to that when I deal with those provisions. But as it stands now, because of the words in clause G, loss to loss cases seem to be possibly not covered. Subsection 3 gives how one is to compute the underreported income, or URI as we could call it. Because the tax is payable on the penalty is payable on the tax on the underreported income. So one has to first arrive at the underreported income. One has to arrive at the tax on that underreported income on which penalty will be applied, and you add one more condition that that person should have underreported his income. So he should have underreported his income, there should be a computation of the underreported income, there should be computation of tax on which you will compute the penalty. These are the stages. Computation of underreported income does not seem to be posing much of a problem. It's quite clear, except when we come to the proviso part. I'll just briefly brush through it. The amount of URI shall be where the income is assessed for the first time if the return is furnished, the difference between the assessed income and the 143(1)(a). If no return furnished, then if it's a firm, then the entire income assessed. It's others, then the difference between the assessed income and the basic exemption limit. Not much of a problem. It's quite okay. In any other case, difference between income reassessed or recomputed and income assessed, reassessed or recomputed in a preceding order. Not much of a problem. Only we have a new animal here. The word recomputing is coming in. Earlier, everywhere it is assessed, reassessed. It is assessed, reassessed, recomputed. Really speaking, nothing much seems to turn, but this is a new animal which is here. Okay, so far so good. Let's come to the proviso. Carefully, let's read the proviso. It reads, where underreported income arises out of determination of deemed total income in accordance with the provisions of 115JB or 115JC, the amount of total underreported income shall be determined in accordance with the formula. That is A minus B plus C minus D. But see the opening portion. Where underreported income arises out of determination of deemed total income in accordance with the provisions of 115JB or 115JC. Therefore, according to me, this presupposes there must be a difference in the incomes qua 115JB. There was a difference between the returned and assessed income qua 115JB. That difference must be there. When that difference is there, qua 115JB or C, only then this applies. Therefore, if qua 115JB there is no difference, your return and assessed is same qua 115JB, but qua normal provisions there is a difference. This proviso possibly will not apply. I hope I'm making clear. I see some blank faces. I hope I made it clear. Okay, you go ahead. It gets further complicated. That's why I thought I must circulate the sections. To my mind, this computation formula in several cases unworkable. Let's see why. Let's see, how do they define A? A says the total income assessed as per the provisions other than the provisions contained in 115JB or 115JC, hereinafter called general provisions. So they are referring to the general provisions other than 115JB or JC. But what does it say? The total income assessed under these general provisions. This is a misnomer, because when 115JB applies, it is the book profit which becomes the total income. What is the starting point for 115JB? It says when the tax payable on your normal income is less than 18.5% of your book profit. If your tax payable on your normal income is less than 18.5% on the book profit, it is the book profit which shall be deemed to be your total income. That is what 115JB says. It is the book profit which is deemed to be your total income. Once that is so, the computation under the normal provisions is just a computation. It is not the income assessed. It is not the income assessed. Therefore, for A to say that the total income assessed as per the general provisions is a non-starter. That's the way I see it. Therefore, A minus B computation fails. Second proviso is there, which says, okay, fine, if there's an item of income which falls both in the book profit computation and the normal provision, if it falls within both of them, it is to be excluded while computing D. Fair enough. That makes perfect sense. Explanation thereof defines preceding order. And now here, I come back to the loss assessed case, loss to loss cases. Now, explanation says, for the purposes of this section, in a case where an assessment or reassessment has the effect of reducing the loss declared in the return or converting that loss into income, the amount of underreported income shall be the difference between the loss claimed and the income or loss, as the case may be assessed or reassessed. This, when we read it, yes, covers loss to loss cases. Yes, it does cover, I admit. But what is this subsection saying? It is saying the underreported income shall be computed in this manner. But the first condition for applying the penalty under subsection 1 was that the assessee has underreported his income. And 2 gives when he can be considered to have underreported his income. So if he doesn't fall in 2, though he falls in 3, again it may fail. Because this only gives what is the underreported income, but does not say that he has underreported his income. That is, for that to be satisfied, subsection 2 has to be satisfied. So this is also a possible problem which may arise. Subsections 4 and 5, to my mind, need not detain us because they are on the same lines as explanation 2 to section 271(1)(c), which dealt with, if there has been an earlier edition on which there has been no penalty and you are claiming that as a source for a receipt or a deposit for this year, then the penalty provisions are to apply in a certain manner. Fine. This is the same thing as explanation 2 to 271. Therefore, we need not break our heads on that. There's a very good salutary provision in subsection 6, which gives the exclusions. So it says, for the purposes of this section, underreported income shall not include the following. This gives 5 items which are saving provisions, taking you out of the penalty of 50% for underreporting of income. First one is quite close. I'm not saying similar, but quite close to the existing explanation 1 to section 271(1)(c). To fall in the exclusion of A, that means to not be treated as underreported income, assessee should have offered an explanation. Those officers should be satisfied that my explanation is bona fide. I have disclosed all material facts for the substantiation of that explanation. There's a slight difference in terminology, but more or less the same thing as brought out in explanation 1. It is this place that saves, say, a legal claim made by us, a legal issue which I'm arguing. If I do not succeed on a particular legal issue, but if I have given an explanation what is my interpretation, and I have disclosed all the relevant facts, that is a classic case which will fall within this exclusion. So we need not be scared of legal issues provided we disclose the proper facts and submit our arguments properly. I don't think in the case of legal issues which ultimately stand rejected, I should be subjected to the penalty because of this exclusion. There could be cases of genuine mistakes. Looking at the facts of the particular case, I would not say all cases of mistakes, but looking to the facts of the particular case, if I can fit in within this clause, saying that I satisfy all these conditions, possibly yes, there also I can possibly get out of the penalty for underreporting of income. Then, when the underreported income has been computed on the basis of an estimate by the AO, subject to satisfaction of certain other conditions, method of accounting, etc., that is also an exclusion. No problem. Next, when the assessee has made an estimate for a disallowance or an allowance, he includes this amount in his return of income. And if that estimate is higher, because of which the AO says, no, estimated disallowance should be higher. In such cases of estimate also, this clause C provides an escape route to say that this shall not be treated as an underreporting of income. Let's take a case of, say, 14A disallowance. I give a basis where there is some rationale to say that, okay, X amount should be disallowed. AO ultimately does not accept that. He makes the estimate as per Rule 8D. This, according to me, is a classic case which can fit in within this exception. That is, I have made an estimated disallowance, so there is some basis. Fair enough. I don't think one can make an absolutely ridiculous, inexplicable estimate and then try to say that I'm going to fall back on this, because there's a requirement of disclosing facts also. So fair enough. Let's not be ridiculous, but as long as your estimate is fair and reasonable, fine. Take an example, car expenses, car depreciation. You disallow 10%, AO estimates at 25%. There's some basis for your 10%, fine. So this is not a case of underreporting of income. Then where there are TP adjustments, fine. I have maintained the information and the documents. I have declared the international transaction and I have disclosed the facts. If I am able to prove this, yes, merely because there is a TP adjustment does not mean that there is a case of underreporting of income. And of course, unreported income, which possibly falls within undisclosed income in 271AA(b), that is such cases, those will not be subjected to the penalty under 270A, they will be subject to the discipline of 271AA(b). We'll come to those conditions to be satisfied in that case. Now these are the exceptions. I am supposed to disclose facts. I am supposed to give a bona fide explanation. What objectivity are we talking of? What clarity are we talking of? How many cases do the assessing officers accept your bona fides? Let's be honest and frank. 99.9% of the cases, they are sustaining or levying penalty merely because an addition has been made. That is the fact of the matter. It's going to continue. What clarity are we talking of? What certainty are we talking of? What objectivity are we talking of? It's going to be a myth. So settled law is going to get unsettled, and people like us are going to have a lot of work. Subsection 7 says it quantifies the amount of penalty at 50% of the tax payable. No problem. Clear? 50% is the tax payable in the case of under-reporting of income. We now come to subsection 8. This is important. Subsection 8 says, notwithstanding anything contained in subsections 6 and 7, if the under-reporting of income is due to misreporting of income, then the penalty shall be 200%. 200% of the tax payable. This brings out two things. One, misreporting is a subset of under-reporting. Because this says if under-reporting is a result of misreporting. This brings out, therefore, that misreporting is a subset, is a part of under-reporting. Other very important criterion. See the importance of the words. It starts by saying, notwithstanding anything contained in subsection 6. Therefore, if you fall within a case of misreporting, the exceptions that we saw in subsection 6 of disclosure of facts, bona fide, etc., all those do not apply. Because 8, when it levies penalty qua misreporting of income, is non-obstant subsection 6. Therefore, brings out that the saving clauses of subsection 6 do not apply in cases of clause 8. Then subsection 9, it lays down the cases of misreporting. They say the cases of misreporting of income referred to in subsection 8 shall be the following, namely A to F. These are the cases of misreporting. If you see carefully, it says cases of misreporting shall be the following, namely. That means this is an exhaustive list. To be misreporting, you have to fall within these 6 clauses. This is exhaustive. Therefore, if you are able to get out of these 6, you will not fall here. Let's see which are the cases of misreporting of income. Misrepresentation or suppression of facts. I think no point in discussing this here further, this now, because everything would depend upon the facts and circumstances of each individual case. So if it is a case of misrepresentation or suppression of facts, yes, it becomes a case of misreporting. Failure to record investment in the books of account. So if you do not record an investment in your books of account and you are found, yes, you are a case of misreporting. One problem I can think of here, or one area where there could be some dispute, is this says failure to record investment in books of account. Suppose in my case, I purchased a property at say 10 crores. 50C value is 12 crores. That 2 crore is added. 10 crore is disclosed in my accounts. Is it a case of failure to record investment in the books of account? Strong case according to me to say that I'm not covered. One may normally be prone to thinking, yes, this would include even a part. Fair enough. But you see the sections in the Act. For undisclosed investments, you have 69. And for investments not fully disclosed in the books of account, you have 69B. So this is an indication possibly that 69 does not include 69B cases. Because B refers to investments not fully disclosed in the books of account. So possibly this could be an area of dispute, and I think we have a decently arguable case to say that this kind of a circumstance is not covered by failure to record investment in the books of account. Yet another one, claim of expenditure not substantiated by any evidence. Interesting. Claim of expenditure not substantiated by any evidence. What is the meaning? What is the connotation of the word any? Does this mean this applies to a case where there is absolutely no evidence? Only those cases are covered? Or is it the case that even when your evidence is inadequate, even those cases are covered? Again, this is going to be an area of dispute. My reading as of today seems to suggest on a strict interpretation which is to be applied in penalty provisions only if there is no evidence whatsoever. Possibly only those cases would get covered by this. See, point is, as time progresses and situations arise where this section will be sought to be applied, that is when the more interesting issues will arise. That is when counsel will start arguing, okay, this is strict interpretation, what is going to apply, what is not going to apply. I always have had the view that the Income Tax Act is like the Bhagavad Gita. We may read it now, it's fine. But if you have a particular issue before you, you have a particular facts of a case, I always make it a point, having read my particular brief, you again read the section. You may have read it 100 times. But if you read the section, something will come. Something different is likely to come because you are applying your mind to the particular issue, to the facts of that case and reading the section. There's a difference. So therefore, my view is, as and when the law develops and the people or the department starts applying these provisions, that's when newer and newer issues will arise. These are only the basic issues which we are now coming out with. But real issues will arise only when these provisions are applied in practice. That's when the real fun will start. That's when we'll see whether there is clarity, there is objectivity, etc., etc. Surely not going to be the case. Failure to record any receipt in books of account having a bearing on the total income. So it's not merely a failure to record a receipt in the accounts. That should have a bearing on the total income. Only those receipts will be treated as cases of misreporting. Failure to report international transactions or deemed international transactions or specified domestic transactions, only failure to report are going to be covered by misreporting. If you have declared the international transaction, you have maintained the info and documents, and you have disclosed all the facts, you fall within subsection 6, which is the exclusions. Misreporting is only cases where you have failed to report these transactions. This nice saving as far as TP adjustments are concerned. Subsection 10, I don't want to confuse further. Subsection 10 gives how the tax payable on the underreported income is to be let's proceed on the basis that it is simply the difference between both the taxes. What is ultimately assessed and what was originally determined under 143(1)(a) or original assessment under 143(3) or 147. Let's leave it at that. And 11 and 12 are rather routine provisions. We need not really bother much about them. Subsection 12 says that the order has to be passed in writing. An order imposing a penalty under 270A should be passed in writing. Quad 270A penalty. An issue has been raised or some debate has been arising on account of whether a penalty levied under 270A is appealable. It's rather surprising. If you see 246A, which provides for appeals to the CIT appeals, Clause J refers to all the penalties. 271, 1C, 271A, 271B, all those provisions are there. But there was no amendment made in 246A to specifically include 270A penalty. So this is giving rise to thought in some people's mind, okay, is it appealable? So then that changes the entire dynamics of the penalty. But my thought is that there is a clause Q in 246A, and that says, when it lists down the appealable orders, it says an order imposing a penalty under Chapter 21. Now, all these provisions, 278, 271, 270, all of them fall in Chapter 21. So therefore, according to me, even if there is no specific amendment in Clause J, Clause Q is wide enough to include an appeal against a 270A penalty. And it makes perfect sense also. We noted earlier that the penalty can be levied by the AO, CIT appeals, principal CIT and CIT. These four authorities could levy this penalty. Now, against the penalties by these commissioners, direct appeal to the tribunal is specifically provided. If you see section 253, you can appeal against the penalty levied by these commissioners to the tribunal directly. Now, therefore, if there is a remedy of appeal against three authorities to the tribunal, doesn't make sense to say that the penalty levied by the assessing officer is not appealable. I can understand if the clause Q was not there, big doubt would arise, yes. But clause Q is there, and it refers to penalty imposed, order imposing a penalty under Chapter 21. I think it is quite safe to say that the appeal lies. I'll just make a passing reference to, for whatever it is worth, 270A penalty can be waived or reduced under section 273A. So that provisions are still available. Those provisions are still available. An interesting connected provision, which is 270AA, which provides immunity from imposition of penalty, etc. This is also interesting. An assessee can make an application to his assessing officer to grant immunity from the imposition of this 270A penalty and also from initiation of prosecution under section 276C and CC. I can make this application provided I fulfill two conditions. One, tax and interest payable as per the order is paid within the time specified in the demand notice. And two, no appeal is filed against the order. If I satisfy these two conditions, I can make this application to the AO, okay, come on, give me immunity from this penalty. Now this application is to be made within 1 month. Note this time because it's important later on when some confusion arises. This application can be filed within 1 month from the end of the month in which the order has been received. There is a prescribed form, there has to be a verification file. Subsection 3 says, if the conditions are satisfied, AO shall, after the expiry of the period of filing the appeal, grant immunity. So therefore, since the word used is shall, if you satisfy the conditions, he is bound to give you the immunity. But there's a catch as usual. Catch says that immunity will be available only where the proceedings for penalty under 270A has not been initiated under the circumstances referred to in subsection 9 of the said section 270A. That means 9 refers to misreporting cases. Therefore, if yours is a case of misreporting, then you cannot get this immunity. If it's a case of simple underreporting, yes, you can get this immunity. Note these words, these are interesting because practical difficulties are going to arise. Note these words, where the proceedings for penalty under 270A has not been initiated under the circumstances referred to in subsection 9. These words, do they indicate that the AO is supposed to notify you? Is he supposed to notify you whether he seeks to apply subsection 9 or not apply subsection 9? This becomes important because you could end up with a situation of paying the tax and interest, not filing the appeal, but the AO rejecting your case, saying that you fall in subsection 9. So it's a difficult situation. So this is also going to give rise to very many practical difficulties. These words possibly seem to suggest that the AO should indicate to you whether it's a case of underreporting or it's a case of misreporting. Because see the words what they say. Where the proceedings for penalty under 270 has not been initiated under the circumstances referred to in subsection 9. Initiated under the circumstances referred to in subsection 9. This seems to suggest that he has to signify to you that whether he is applying 9 or no. Only then practically it makes sense. This is one fundamental practical difficulty which may arise. Now, there is a time limit within which he has to pass the order, either rejecting or accepting your application. Within 1 month from the end of the month in which the application is received, he is supposed to pass the order. Fair enough. But if he is rejecting your application, he has to give you an opportunity of being heard. Interestingly, the order says, the subsection 5 says, the order under subsection 4 shall be final. It shall be final. If it's an order granting you immunity, great, it's final. But if it's not granting you the immunity, then what? Subclause 5 says it is final. It's final in the sense you cannot appeal against the same, but the remedy of writ is available. there must be something you must continue to do to keep it alive. Because tomorrow, when the AO levies the penalty, he may tell you that I rejected your application for immunity on the ground that you are covered by 9, and you have let that position become final. If you have let that position become final, when he levies the penalty, he levy you for misreporting, not underreporting. These are practical issues you have to keep in mind. So you must not let that order become final. At least there should be an objection on your part to the department by way of a letter saying that we do not accept that this is a case of subsection 9. There should be something which is on the record of the department whereby you can say that I have not accepted this order to be final. Because otherwise, what are you going to argue in your appeal? When he levies a penalty of misreporting, what are you going to appeal? What are you going to argue in your appeal? He already passed an order saying that this is a case of misreporting. You have let that become final. So that's the end of the matter. Yes, of course, when you have been granted the immunity, no appeal or revision under 264 shall lie against that order. Very fair enough. Interestingly, another practical difficulty can arise. I don't know why they have not taken care of. See, there is a saving provision in 249. There is a proviso or an explanation which is inserted there, which says that in computing the period of limitation for filing the appeal to the CIT appeals, certain period should be excluded. But this is not adequate. I'll demonstrate with an example. You were to file your application for under 270 AA within 1 month from the end of the month in which you received the order. But your time limit for filing the appeal ends with 30 days from the date of receipt of the demand notice. So you can have a case where, therefore, in most cases, your application under 270 AA will be post the expiry of your period of 30 days under 249. In many cases, this is going to happen. And if you read carefully the 249 for the amendment, the period is excluded. Which is the period excluded? Period from date on which the application made to the date on which the application is rejected. Period from the date of making the application to the date of rejection of that application. This is the time period which is excluded. But in many cases, your 30 days would have expired earlier. Let's take an example. You receive your order on 3rd of January 2019. Correct? You receive your order on 3rd of January 2019. You can file your application within 1 month from the end of this month, that is 28/2/19. You received on 3/1/19, you can file on 28/2/19. But your period for filing the appeal expired on 2nd of January or 2nd of February 19. And your saving period for the exclusion starts from the date of filing the application, which may be much post, because your outer limit was the end of Feb. You may have filed it on 25th Feb. You don't get the exclusion of that period. So sensible thing to do is, if you're thinking of this, do everything ASAP. You file your application under 270 AA ASAP, so that you're not caught within this rigmarole. As these provisions are administered, you will have a lot of difficulties. The right thing possibly should have been done is that you give the extended time limit from the date of receipt of the assessment order to the date of rejection of this application. Because as it is time bound, right? It's time bound. So right thing to do would have been that. You give this, if it stands rejected, then fine, you give me the right to file the appeal, fair enough. Today also, like this is another difficulty. They should not have possibly done this. They say you must pay your tax and interest and file your application. What if the man rejects thereafter? I am going to appeal, fine, but my tax and interest has been paid. Right thing would be that if they are tomorrow accepting my application for the waiver of the penalty, then fine, then I will pay the tax and interest. At the most, you may charge me interest for that 1 month or whatever it is. Fair enough. But don't put me in a situation whereby I have paid the tax and penalty, but I still have to go on contesting the appeal. There are other provisions which are amended, 271 AB, AAC. Are you in the mood to listen or no? Or have we had enough? I'll take a few more minutes. (271) This deals with penalty in search cases. You see, one needs to keep track because these provisions are being amended so often that one loses track. So when suddenly your client is having a search, you're really searching for which of the provisions apply. That's why I need to just keep abreast with 271 AB. If there was a search post 1st July 12 and before 15/12/2016, 12 to 15/12/16, the provision said that if you admit the undisclosed income in the statement under 132(4), you disclose the manner, you substantiate the manner, you file your return within the 139(1) time limit, and you pay your tax and interest under the 139(1) time limit. If you satisfy all these conditions, then your penalty would be 10% of the undisclosed income. This was great. You have undisclosed income, you get a search, you're ready to pay tax, and 10% of undisclosed income is your penalty. We've been getting away with this for quite some time. 2 was a situation where you did not admit that in the course of the search in the statement under 132(4). But if you satisfied the other conditions, say you returned it in the return, you paid the tax, return is filed in time, taxes, interest is paid in time, 20% penalty. Fair enough. And in other cases, there was a provision, if you don't fall in either of these, then it is ranging from 30 to 90%. That could be the quantum of the penalty. Finance Act 1916 changed this 30 to 90% to a flat 60%. Now, the Taxation Laws Second Amendment Act is making some amendments in 271 AB. Now it is inserting subsection 1A. So in this case, post-search 15/12/16, if you are satisfying all those conditions of admitting, returning, paying the tax and interest, your penalty will be 30% of the undisclosed income. So it's raised from 10% to 30%. And in other cases, it is 60%. So now 271 AB penalty has substantially increased to 60%. So if you're caught in the course of the search, you pay tax of 30 and you pay another 30% penalty. This penalty is based on the undisclosed income, 30% of the undisclosed income, not the tax. So it is 30 plus 30, it comes to 60. Just 2 or 3 minutes on additions in respect of sections 68 to 69D. These sections have been tampered with, particularly qua the tax payable thereon and the penalty relating thereto. We had 115 BE, which has been inserted with effect from the AY 13-14, to say that if your additions are made under section 68 to 69D, you will not get any deduction for expenses, you will not get set off of losses, and the tax rate would be a flat 30%. Now, the Taxation Law Second Amendment Act says no. Now the tax will be not 30%, it will be 60%. So 68 to 69D editions, this has a very great practical difficulties. 68 editions which the department makes right, left and center. This is going to be subjected to tax at 60%, not the normal rate of 30%. Very dangerous. There's a silver lining. For these editions, there is now a separate penalty which is provided, which is under 271 AAC. This, if you read this section, of course, this is not the time to drag the discussion any further, but if you read this section, it is very peculiar and doesn't seem to make a lot of sense. But basically it says that if your addition is made in respect of section 68 to 69D, then your penalty will be 10% of the tax, only 10% of the tax. Therefore, you'll end up paying tax of 60% and the penalty of 10% of that. That means your total outgo is 66%. So you will not fall within the normal underreporting, misreporting provisions. You will fall under 271 AAC, where the quantum of penalty is 10% of the tax. Why I said this is odd, this section is odd. See all other provisions, 271 1C, it says penalties for concealment of income. 270A says it is for underreporting and misreporting of income. But this, if you just carefully see this section, it doesn't refer to for what the penalty is. It says when the assessed income includes additions in 68 to 69D, penalty will be levied. Okay, if you want to do that, but then there's a discretion which says the authority may levy this penalty. And there's an opportunity of being heard. Now what is the meaning of all this? He may levy this penalty. But what is the basis on which he is going to decide? He is going to give an opportunity of being heard for what? Am I going to say that, okay, there's a difficulty in getting the confirmations, getting that man's bank statement, getting his balance sheet to show the, nothing. There's nothing available in this section as to what are the criterion to apply. So be that as it may, this is the way these penalty provisions stand at the moment. Thank you very much for a very patient hearing.
Just thank you for being so patient. A few more minutes, please. May I request Jankna to please propose a vote, make a few announcements and also propose a vote of thanks. Thank you.
Respected dignitaries on and off, and dear friends and seniors, Thanksgiving came so early. Is it just me feeling or everyone is feeling the same? So before Thanksgiving, I would like to highlight some forthcoming events in BCAS for the benefit of one and all. The first event is on 5th April, Implications of Benami Properties Act. Speaker is Mr. Dilip Seth in BCAS Conference Hall. Second event is 12th April, Practical Issues in Implementation of ICDS. Speaker is Mr. Yogesh Thar at BCAS Conference Hall. Third event is on 7th April, 7th, 8th and 15th April. That is 7th Intensive Study Course on Advanced Transfer Pricing. Speakers, various eminent speakers are there in BCAS Conference Hall. The fourth event on 29th April, the topic is Seminar on Finance Act 2017. Speaker is CA Anil Sathe, CA Gautam Nayak, Mr. Devendra Jain and CA Namrata Dedia at BCAS Conference Hall. And the last event is Indirect Tax RRC on 9th June, various eminent speakers at Pune JW Marriott. So gratitude is an inward feeling of kindness received. Thankfulness is a nature impulse to express that feeling. Thanksgiving is following of that impulse. So it is a matter of immense pride for me on behalf of BCAS and entire fraternity to deliver vote of thanks to Mr. Hiro for being with us by taking his time out from his busy schedule, who is a source of inspiration and motivation with his vast knowledge and acumen in the subject. We are greatly encouraged by his gracious presence and immensely benefited by his inspiring address. His address set the tone how important penalty provisions are by clearly indicating the legislative intention for bringing the new provisions under the Act. I would also like to thank a moment and thanks to all of you, and would like to end with the below quote: "An ignited mind is the most powerful weapon on the earth, above the earth and under the earth, and this is got through education." So there is a great time ahead of us. Country need our service and we just need to render it. Thank you.